So you think demand and supply zones work? Then answer this. If every trader knows them, why is almost everyone still losing? Here's the truth. Most traders draw zones randomly, with zero understanding of what actually moves the market. You've been told. Demand equals where price goes up. Supply equals where price goes down. Sounds simple. Too simple. And that's exactly why it doesn't work. Because the market doesn't move on demand and supply. It moves on liquidity. Let me break your illusion. If everyone marks the same demand zone, everyone places buy orders there, and everyone places stop losses just below it. Now think, if everyone is buying, who is selling to them? And more importantly, where does the money come from? The market doesn't create money. Oh, it transfers it from losers to winners. So what happens next? The market goes below the demand zone, hits those stop losses, takes the liquidity, and then moves up, not before, after. That move you thought was respecting demand. No, it was hunting liquidity. Same thing on the sell side. Supply zone, retail sells, stops above. Market goes up first, takes their stops, then drops. This is how the game actually works. Now look at the chart. You'll see it everywhere. Price taps the zone, breaks it slightly, kills the stops, then makes the real move. That fake breakout? That's not fake. That's the real move starting. So what's the takeaway? Stop trusting zones blindly. Wait. Wait for the liquidity to be taken, then enter, not before. Because if you enter early, you become the liquidity, and the market will take you out. Simple as that. Now, I think we should look at some practical examples on the chart. Look at this recent example. Here you can see the yellow market area is a demand zone, where the market retested multiple times and moved up. But at point B, the market wicked below the demand zone and took out the stop losses of retail traders who had placed their stops just below the zone. After taking out those stop losses, the market moved up. This is what we call liquidity being taken. In this case, we can clearly see that the market didn't respect the demand zone. It used liquidity to move. Let's take another example. Here you can see the market was respecting a strong demand zone marked by the yellow region. But then suddenly, at point D, the market took out the liquidity, or stop losses, below the demand zone and moved up, giving us a bullish move. Later, when the market came back to this zone again, it gave another bullish move because the liquidity had already been taken. So what is the conclusion of this video? Wait for the market to take out the liquidity of a demand or supply zone. Once liquidity is taken, that's when you look for entries. Don't blindly trust demand or supply zones. First, wait for the market to hunt the stop losses around these zones. Then, you are good to go. This demand and supply topic is a long one, so we'll make another video on it as well. For now, focus on understanding this simple concept and backtest it. And don't overcomplicate liquidity zones. We'll cover them in detail later.